Tuesday, June 20th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at an epic bubble today. Yes, I think it's one of the biggest ones. And people are going to look back years from now and they're going to write about it. It might be in Charles Mackay's new edition book about popular delusions and madness of crowds. It's the UK real estate bubble. Yes, it's been going on since around the late 90s after the New Labour came into power. They also allowed banks to get into the mortgage market. Before that, it was just building societies. And they created that bubble. It was New Labour. It's not just a conservative thing. It's a whole political class that has tried to perpetuate the bubble. And I think it's an epic bubble. And as Newton said in his third law, for every action in nature, there's an equal and opposite reaction. And that bubble burst back in 08, 09, but they did everything. They threw the kitchen sink at it to keep it going, and they did it again in 2020, 21. But now I think it's on its last legs, unless they bring in the jacuzzi and throw it at it. Things are not looking good. So that's what we'll look at today. Yes, Rudy and I have been out, and it's been raining quite hard this morning. We got wet when we left the house. It was just a drizzle, but everything's fine. And I have been warning, of course, for the last few years about not just the monetary policy of the central banks, but also the profligate spending of governments through deficit spending. Deficits have been running very high, not just in the US, but in the UK. They've been doing everything to keep the consumer going, to keep housing wealth elevated here in the UK. And why do they do that? Well, because it's popular with the voters. It makes people believe that they're wealthier than they are. It makes people go out and take other loans because they think, well, I bought my house for 500,000, now it's worth $1 million. I'm £500,000 richer. But a lot of people forget, of course, that unless you sell that house, you haven't really made 500,000, and then you have to buy another one, of course, and that other one has probably gone up as well, unless you move to a different area where houses are cheaper. So it's been a main driver of the UK economy, housing. Unfortunately, the UK economy is much further along than, let's say, the US economy in terms of deindustrializing. The UK was an industrial and manufacturing powerhouse in the 1800s and even up to the 1920s or 30s, I would say, or even the 50s, 60s, and 70s. But now we've become a finance-based economy. We've been financialized, and yeah, we've had a central bank that's kept interest rates negative in real terms from 2008 to until recently, late 2021. And it's not just the Bank of England, of course. All the major central banks did it. And now things are starting to unravel. I would say I warned about a month ago that the gilt market, where interest rates are set in this government bond market, not just for short-term rates, but for longer-term rates, was not looking good. And many of you know, of course, that I worked in the bond markets and for 20 years, government bond market. And I can tell when things are getting bad, not just fundamentally, but technically through the charts. And the charts are continuing to look really bad for me. And I made another video a couple of weeks ago saying that we're going to have probably the worst bond crisis, interest rate crisis in recorded history, not just in the UK, but in the US and other European countries, where they kept rates artificially low. And it's what Newton said: you can't fool Mother Nature for too long. And interest is just the price of time, like Edward Chancellor says in his book that I'm still reading and I highly recommend. So if you set rates negatively, you're saying that time doesn't matter, that everyone is going to live forever. And that doesn't work, right? Because we're all mortals. And Bank of Japan's still doing that strategy of negative rates, and they're going to pay for it too, the Japanese, unfortunately. So, and now people are starting to wake up. I remember I made a comment about a month ago on social media. I saw one of these people who have been around for a long time, and there's many of them saying that they've built a huge buy-to-let or buy-to-rent portfolio, and they can teach you how to do it, how everything's easy, and you're gonna make loads of money. You buy this property, you rent it, you make money. And he was saying in this post that interest rates were topping and that they're gonna come down. And I said, well, I don't think so. I think they're gonna go a lot higher. And this person replied, oh, they never go up that much. But I guess he didn't look back in 1990 when interest rates were at 12%. So we're starting to see, of course, a lot of stories coming out in the mainstream now about this. It's not just Maneko64 here on YouTube. And a month or even 6 months or 12 months or 2 years ago when I was warning about this, people were like, didn't really care. But look at this one here. This came out in the FT overnight. First time buyers struggle as mortgage products cut by 40%. Rising interest rates prompt lenders to clamp down on borrowers with small deposits. And then you have two-year UK mortgage rate rises above 6%. For the first time since 2008, two-year gilts also pass 5%, ahead of expected increase in interest rates this week. And we also have the CPI and RPI data tomorrow. They are measures of prices. People call them inflation data, but as you know, the inflation has been created, of course, by the central bank and the governments through their profligate policies. The central bank keeping the base rate negative in real terms for like 13 years or even 14 years. Well, we're still negative right now because the base rate is 4.5%. The CPI is running almost at 9. The RPI is at 11. So policy is still inflationary, and that's what people don't understand, because they've been fooled into looking at CPI for inflation, and it's not. It's the cost of money. So the cost of money and credit is still negative. And I'm afraid the only way for the Bank of England and the government to rein in price rises or the inflationary pressures is for interest rates to go above the CPI and the RPI. But by then, the whole housing sector will have collapsed. The whole economy will have collapsed, because it also affects credit card rates. It also affects consumer credit. It affects corporate credit rates. It affects everything. It affects the government. Who are they going to, how much is it going to cost for them to borrow with the debt piling up? And the other thing that's happening now is that the Bank of England, they bought about almost £1 trillion worth of bonds and corporate bonds, gilts and corporate bonds since '08. And now that portfolio is in the red. And they did a deal back in '08 about QE with the Treasury that if the Bank of England made a profit on their portfolio, they would send it to the Treasury. But if the Bank of England made a loss, the Treasury would have to cover the Bank of England. So who's the Treasury? We are the general public, the taxpayer. So there's that problem there too. So what does it say here in the FT? Because we've seen that most people now expect government to do everything to solve every crisis, even though governments and the central banks are the ones that really germinate the crises. I would say it's always them. So it says the cost of 2-year fixed rate mortgage in the UK rose above 6% on Monday, piling pressure on homeowners and Rishi Sunak's government. In an indication that government rates could rise even further, 2-year gilt yields rose 0.14 points, breaking through the 5% barrier to their highest level since 2008. Despite the growing political risks, the Prime Minister rejected providing extra help to struggling households, arguing that his plan to halve inflation was the best and most important way that we can keep costs and interest rates down for people. Ministers are instead telling lenders to live up to their responsibilities and help the vulnerable. Well, lenders are not charities. They're businesses. It's also costing them a lot more to borrow so that they can lend. This is what these ministers don't understand. So am I saying that the government should help? Of course not. I'm totally against government interference in the markets. But I think when push comes to shove, they might try to help. The Bank of England might step in. We'll have to see how bad the gilt market gets, how bad prices drop and yields go up. And to me, it's not looking good. And we're going to have a look at a chart that I drew yesterday. And you have to understand that the 2-year gilt yield and the 2-year gilt price is usually very stable, or it used to be back in the day, back before QE, because it's only a 2-year loan. So the duration is very short, so there's not much volatility. But what's happened with 14 years of zero interest rates and massive QE, it created a major bubble in the bond price. And why is that? Well, because in order to drive interest rates low, to allow people to keep borrowing and taking on huge mortgages, that's what they had to do. The other thing it did, it made a huge, of course, house price bubble. A house price bubble that's totally ridiculous, and I think is going to deflate massively in real terms. And why did it do that? Well, because borrowing at 1 or 2%, you can borrow a lot more because your payments are going to be less. But borrowing at 6, 8, 7, you can borrow a lot less. So the house prices are just like a bond price. When yields go up, bonds go down, house prices are going to go down, and they're already doing so. And so the bond bull market that we had from like the early 80s up until the end of 2021 was like akin to going up the escalator. There's an old saying on Wall Street, a bull market goes up in an escalator, but then all of a sudden it falls through the elevator shaft. And that's what we're seeing. Not just house prices, but bond prices are collapsing. And that's why yields are going up so quickly. So if you turn the yield chart upside down, it's the same thing. And the same thing is going to happen to house prices. Of course, government can do things to try to help. And they have implemented some forbearance rules late last year because they saw this coming. They're going to help people on universal basic income to keep interest payments going. But they're going to have a condition on that. Yes, government will help you pay your mortgage interest, but then you're going to have to pay back the government. So it's like you're going to have to double down and borrow even more. So some of you might say, well, that's the plan to basically make sure that the general public doesn't own anything, that you own nothing and be happy. That might be so. That might be so. And maybe they won't come to the rescue. And what this will lead to, I think, politically, is a new party in power, Labour Party. And what are they going to do? Well, they're going to come in on a white horse, Keir Starmer, and say, I'm going to save everyone. I'm going to give you universal basic income so you can stay in your home and pay your mortgage. And most people are a lot of people are going to say, wow, great, Labour is doing something. The Tories ruined everything. But they forget that this housing bubble actually started under Tony Blair and Gordon Brown. And they are just as much to blame for all the QE and money printing we've had since 08-09, because their policies back in the early 2000s created the massive housing and subprime bubble that we saw burst. So I think that is a possibility. And one thing's for sure, they're going to try to keep things going. And the thing that will suffer from that, of course, will be the currency. And I expect the housing market or real estate to be very moribund. And what do I mean by that? There will be a lot more or a lot less, excuse me, deals go through, sales. It's not going to be as easy to sell your property because people won't be able to afford it. And some people are going to be stuck in their homes with a big mortgage that they can barely just afford, and they won't sell because they wouldn't be able to get another mortgage deal. So that's how it's going to become. So before we look at the markets quickly, I just wanted to show you the chart. I tweeted this out yesterday. Epic real estate crisis, all but certain for Britain. This is the 2-year gilt yields. And why do I say all but certain? Because, well, nothing in life is for certain. But the probability of this happening is really high now, and that's why I'm telling you about it. And I've been warning, of course, those who wanted to listen for many years. So I've spoken about technical analysis. So what we have here is a very bullish formation, which in this case is very bearish for the real estate market because it's yields, interest rates. And we have to remember, when interest rates go up, house prices go down, bond prices go down. So here we have, we were at even negative rate towards the end of 2020, even in 2021. We had a negative 2-year gilt yield, which meant the government was getting paid to borrow money, which is a crazy thing, of course. And then we just fell down, or that elevator shaft, if you turn this chart upside down, and yields went, yeah, pretty much in a straight line from around 0 to 4, just above 4%. And that was back last year in September, October, when he had the first crisis, gilt crisis, the trust and quarantine crisis. And then we consolidated into this little triangle, and these are called continuation patterns. And there's a 3 in 4 chance that the pattern resolves itself in the direction of a previous trend. And it has. As you can see, we've broken the top of the triangle instead of the bottom. So now, what's the distance that it will go up? Well, it's the same distance that it went up in the first leg. So you add about 4% to around 4, and you get 8, a 2-year gilt yield with 8%. And I think that could happen by the end of 2025. Yes, it's not a straight line, but don't forget, this is a weekly chart. So I think it's happening. And as I said, the only way for them to stop this would be for the Bank of England to step in and do massive QE. And QE just means they'll go in there and start buying gilts. but then they'd have to switch their policy of raising rates and fighting inflation, and that would totally destroy the pound. Or there could be some kind of crisis out there that justifies them stopping this, some kind of existential crisis for the country, a war or something else. I don't know. I'm just trying to tell you what I see here. So there you go. Not looking good. And the thing is, you might ask, so how come people don't see this? How come the mortgage brokers, the real estate people, or the government, they don't see this? Well, because they probably never worked in the bond markets to recognize that formation, or what that means. And that's why they're always too late to react to things. They don't anticipate things. So that's how I see it. So with that, let's quickly look at where the markets are this morning. So it's 8:30 a.m. London time. We've got spot gold at 1953. That's up just under $3. High's been 54, low 43. Spot silver is down a couple of cents at 23.93. High's been 24.04. The low's been 81. Dow futures is down 8. Nasdaq down 14. S&P down 3. The pound's unchanged, 127.95. The euro is up slightly at 109.36. And the dollar is down about 0.1% versus the yen at 141.81. Dollar's up 0.2 versus the yuan at 717. I saw the People's Bank of China cut rates by 0.1% this morning. To the other currencies, Aussie dollar is above, just above 68, but it's down 0.2%. The dollar is unchanged versus the Canadian dollar, 132.18. And the Kiwi dollar is down 0.25% at 61.84. WTI crude, that's up 0.25% at 71.60. Brent is up 0.4 at 76.37. Platinum is down $3 at 9.75. And high grade copper is up 0.2% at 387.70. Let's quickly look at the gilt market, important market for the UK economy. Well, the 10-year gilt yield is at 5.11 right now. So yes, we've broken through that 5 level, and it doesn't look good. The US 10-year yield is at 3.79. That's up 2 basis points. The 2 years at 4.72. So with that, I'm going to wish you all a very good day. Take care. Bye.